Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
Welcome, everybody. We've got a great session today. I'm joined by Mark Peterson. Mark is the Director of Market and Portfolio Insight at BlackRock. I think everybody here knows BlackRock is such a great partner to us at Prosperity Capital Advisors, helping us drive our United models, also our multi-asset income models, the BlackRock SMA for fixed income, just so many great solutions that we have, of course, with BlackRock, the world's largest asset manager. And Mark, I'm happy to be jumping in to talk about investor psychology today. This is something near and dear to us. Obviously, we have pioneered the bucket plan as our holistic wealth management process. And for me, so much of the bucket plan is just controlling emotions, keeping investors in their seat, making sure they have a plan so that when times do get challenging in the market, they don't make irrevocable decisions that can harm their portfolio. So I'm looking forward to jumping into our conversation today.
Absolutely. Thanks for having us today.
So, Mark, let's talk about investor psychology. We're basically talking about behavior at the end of the day. And so share with us a little bit about why that's important when it comes to investment planning.
Really comes down to performance at the end of the day. I think we've all seen studies showing what happens when investor behavior goes off the rails, what happens to performance. So it's really just trying to maximize the outcome, make sure some of those emotions don't get in the way and really eat into performance. That's really the crux of it, what we're getting after, trying to create a better overall outcome by minimizing those emotions. We think about it, it really is the foundation of any good investment plan is that investor behavior, right? It's right at the foundation. It doesn't matter how good of a portfolio you built or right how good your estate and tax planning might be if the client's emotions go off the rails and they move to the sidelines, they do something they shouldn't do. That's why it's such a critical topic for us, just fundamental to building better outcomes at the end of the day. And we've all seen it. We probably all lived through periods like certainly first quarter of 2020. There were some studies that showed during the pandemic and the shutdown first part there were studies that showed 1/3 of retirees sold a portion, if not all, of their stock portfolio in that first quarter. Think about the damage that did to their outcome there as the market took off right after April, May of 2020. So for us, it's all about just getting better outcomes, trying to maximize that performance, making sure those emotions don't get in the way.
Absolutely. To your point, it's hard to make three correct decisions when markets are going haywire, when to get out, when to get back in, when to get back out. And I know you've claimed that you don't feel the industry spends enough time on the subject of investor behavior. Why do you think this aspect is being ignored so much?
I think there's a lot of things that go into that. I think first off, knowledge, right? I think a lot of folks just don't get educated on the topic and all the different areas. It can seem a little like academic too. I think that certainly scares some folks off. And certainly part of it is pretty academic in nature, some of the research that's been done. I think one of the other pieces that I see quite a bit with advisors across the country is it can be a little intimidating when you have a client who's super successful. Think about doctors, lawyers, all the entrepreneurs, small business owners that we deal with as financial professionals. Some of these folks are tremendously successful and intelligent people. And sometimes it can seem a little awkward having conversations about letting their emotions get out of whack. And I think some folks just aren't comfortable with that. And that's a bridge that I think advisors need to cross, because there is a lot here, as I think, as we all know, that we can provide and be that check and balance emotionally for even the smartest, most successful investor that we have, even somebody that has got a lot of investing experience. So I think sometimes that becomes a little bit of an obstacle, just that getting over that awkward bridge to better understand that, hey, we can be a good resource, that check and balance, educational piece for those investors to better understand how their emotions can derail their success. And Just to put it in, add a little nugget here at BlackRock, we actually have behavioral coaches for our portfolio managers. So our best investors even have that check and balance built in. Because again, it comes back to performance and any way we can maximize it so they can better understand their challenges, the better the outcome will be. That's how seriously we take this topic. And I think great example, even professional investors can have pitfalls that they fall into. They often are very different than somebody who's not as experienced investing, but they're still there nonetheless.
Yeah, I want to talk about some of these pitfalls in a minute, but before we do that, and again, this is an open forum, so if anybody has any, advice or wants to chime in or has a question, please feel free to. But do you have any like kind of best practices, ideas, maybe questions that can tee up this conversation as we're sitting down with a new potential client and we're starting to map out their retirement plan and their investment portfolio? Is there anything that you've seen that's like a good opener to start this discussion?
Yeah, I think one of the things that I've been talking a lot about lately is just understanding that some of these pitfalls come out of our challenge with dealing with uncertainty as humans. So think about uncertainty can be pretty paralyzing. And there's famous saying that we'd rather get bad news than no news at all. And that no news at all is really something that I think our industry is always dealing with. Think about it from a market standpoint, think about it from an economic standpoint, think about it just how the portfolio will perform. There's no guarantees, as we often say in the industry. And I think just understanding that you think of some of these pitfalls, some of these biases are there to deal with that uncertainty. So I think it's good to tee that up and just to say, hey, we need to understand that uncertainty is a challenge for all of us. We need to understand how our emotions try to bridge some of that gap. So I think that's one way to bring it up is just to say, hey, uncertainty is part of what we deal with here every day. Having a plan is the best way to mitigate some of the challenges with that uncertainty. And one of the other ways that we've seen it done pretty successfully is you mentioned the bucketing plan, which I think is fantastic because that's exactly what we're getting at. But also a layer underneath that is have a bear market plan. One thing we've heard from investors across the country who do this is don't just talk about, hey, what are we going to do if the market's down 20, 30, the portfolio's down 20, 30, 40% next year, next quarter. Talk about it all the time, right? Not just once you get there, right? Because in the heat of the moment, we saw this in various periods recently, whether it was financial crisis, the pandemic, you get into that heat of the moment, the emotions are already revved up and that genie's out of the bottle. You really have to do it at each step along the what can feel like the roller coaster, right? Like right now, the market's doing well and we've had a good run in stocks and even bonds have bounced back year to date. Have that conversation. Hey, what are we going to do if the portfolio is down? And what we've heard both from advisors and investors is that having that conversation at each step along the way might seem tedious, right, and tiresome because you'll say, oh, we're going to rebalance. We might take some tax losses, right? We might increase contributions if available. All those things are good parts of a bear market plan. But we heard from investors especially is having that conversation each step along the way change the conversation going forward because they realize that's a different conversation based on the value of where the portfolio's at, where the market's at, where the uncertainty meter is, right? If there's a lot of uncertainty, it can be difficult to rebalance. Think about rebalancing back in March of 2020 during the height of the pandemic. Our model portfolios did that. A lot of investors were doing the opposite, I think, as we all know. So for us, that's where I think the bucketing approach is perfect. Having that plan in place is the best way to do it, to bring up that conversation. And for the most emotional clients, do it more deliberately every time you touch base and just say, hey, remember, this is what we're going to do if the market does go down. And that really helps neutralize some of those emotions. And you'll be better able to execute when you need to, when the market's down 20, 30% and you need to do something with the portfolio in a positive way.
Yeah, that's great. For those, of course, with the bucket plan, one of our tools that I love is the volatility tolerance analysis, because this gives me a chance to proactively talk about this with clients. And one of the questions that I really focus on, and I talk about this in the bucket plan training a lot, is when we're going through the soon bucket questionnaire, it's question number 3. How would you rate your willingness to take on market volatility with the accounts that you depend on for distribution sooner rather than later? And then there's 4 choices: no volatility, low volatility, average volatility, and above average. And the reason I love this question is I have a lot of clients that'll say average volatility. And what that does is it gives me an opportunity to educate them on what average market volatility is, right? We've all seen the data that the S&P 500 on average falls at least 10% almost every single year. I think it's 93% of the years going back the last 80 or 90 years. And then I'll also share that if we look at the last 20 or 30 years, the S&P 500, which is a good proxy for the average market, has fallen 30, 40, 50%, 4, 5, 6 times. So I'll say to the client, you're telling me with this soon bucket, the money you're going to need to rely upon for income, you're willing to take on average volatility, which means if the market falls 20, 30, 40%, you're not going to be calling me. You're not going to be worried. And they're like, oh, maybe I don't want average volatility for my soon bucket money. Maybe I want low volatility or no volatility. And so that's really important when you're onboarding and building a plan for a client. But just last night, I did an annual review for a client of mine. He's been a client for 4 years. He's 3 years away from retirement, very highly intelligent academic person. And we redid his volatility tolerance analysis last night in our annual review. And we got to that same question again. And he said average volatility. And we talked about that. And I think the best time to address it, as Mark just mentioned, is not when a market crash happens. It's in the good times right now to just make sure that people understand what they're actually invested in and how it could react if things go sideways. Just go back and use that tool, the volatility tolerance analysis, because there's just so much insight that if you dive deeper into those questions, you could really help alleviate a lot of these bad behaviors before they come to light.
One thing I'll jump in, Dave, just I think we poked at it a little bit. I think one way to bring it up and to consistently drip on folks is just the education piece. Something we highlight here a lot at BlackRock. If you go to, we've got a student of the market page that has a lot of behavioral related charts, a lot of what you mentioned. I think that's a great way to bring it up, but constantly drip on folks. I think they appreciate it. Even though if they might not be a charter graph person, I think they appreciate trying to bring them up from an education standpoint, because better education can help minimize some of those emotional challenges as well. If they just feel like they're better armed, right? We talk about the discipline muscle, right? The discipline muscle for investors is often best worked out by increasing education, right? Just constantly dripping on them. Some of the stats you talked about with the market and all those things can help really get after those emotions.
Yeah. So when we talk about investor psychology, one of the things you mentioned earlier is just investor biases. What exactly are those?
Yeah, some of these biases are really the pitfalls that folks fall into consistently across the board. You can think about, and they're all, this is where it gets a little bit academic. And I try to avoid some of this with investors because they all start sounding the same at a certain point, right? But you have things like recency bias, right? Where folks will just naturally think whatever's happened recently is going to continue on forever. And I think you're seeing that now with the market to some degree where, hey, individual stocks, especially those Mag 7 stocks, feel like they're going up forever. But we all know that's never going to last, right? They're not going to go to the moon. That's a great example. And that all ties back to that uncertainty topic. Think about, why do we use recency bias? It's to alleviate the fact that we don't know where things are going. So we just extrapolate what's happened recently into the future. And of course, that's a pitfall. And you get other things like overconfidence. That's something we often find with experienced investors. They're way overconfident in their abilities to predict the market, to crystal ball the market. And that's, again, a way to deal with that uncertainty. So if you start going through a lot of these different challenges that we have emotionally, again, it really comes back to how investors deal with that uncertainty. But we can go through a laundry list. You could probably search the internet and find hundreds of these different biases, but they're all similar. They're all connected, and most of them in our industry come back to that challenge with dealing with uncertainty.
Well, and I think, the one I run into most predominantly is the S&P 500. I think that anybody who's in a prudently diversified portfolio has been penalized in the last decade pretty much because everybody's benchmarking us to the S&P 500 and they're seeing the performance of the S&P 500, and that's the recency bias, I believe, in looking backwards over what's happened in the last 5 or 10 years. How are you talking about positioning that specifically? Because I'm sure other advisors are running into that where we're implementing globally diversified portfolios in multiple asset classes, but then everybody's, why aren't we just invested in the S&P 500?
Yeah, we call that S&P envy. We actually give it its own name, and we have a chart on this that shows how S&P envy comes about. We often say the diversified portfolio doesn't always feel good, and usually it doesn't, because you go through the dynamic where you still lose money in a diversified portfolio when the market's down, right? And think about years like 2008, 60/40 portfolio was down over 25%. That never feels good. Being a quarter of your assets gone in a calendar year, probably one of the worst years ever for a diversified mix. And then on the other side, you trail, right? You trail the S&P in a big way. Think about the period from 2009 to 2019. There was an 11-year stretch where the S&P is up 350%, but the diversified portfolio is only up about 230. And 230% is great, but that seems like a enormous gap between a diversified portfolio and the S&P 500. And that's where the S&P envy comes from, where you just get this envy and regret that's so natural with a diversified portfolio, because you're never going to be, or rarely are you ever, the top peg in the rung. For us, we've got a chart, and we'll actually send it to you and follow up, that shows this S&P envy playing out over time, where you lose money, you trail, you lose money, you trail. Just never feels emotionally satisfying. Yet we looked at, and this goes back to the beginning of the tech bubble, the diversified portfolio has actually slightly outperformed the S&P over the last 20 plus years. And this tends to be a draw dropper for investors, because you're right, they just remember what's happened most recently, but they forget about some of those other periods, especially when you get a big bear market. That's oftentimes where the math starts to work in our favor. And oftentimes, and we do this to ourselves as an industry, where we don't look at the bear and bull in combination, right? We look at the 1, 3, 5, 10. Mm-hmm. And oftentimes that doesn't equally have that good and bad market in the same degree as you do when we look at this chart that we'll send you, that looks at here's the good, the bad, but we're looking at them equally over a full cycle or multiple full cycles. It's easier to see why those emotions can be so challenging, why that diversified portfolio never feels good.
Yeah, that's great. I definitely need to get that S&P MV piece. If you can send it over, we'll get our marketing team to distribute it out to everybody on here. I know for me, a lot of times I just pull up Quanti and I say, suppose we had all of your money in an investment like the S&P 500. And suppose we go through a time period like 2000 to 2009, that 10-year strip there. And I show them the performance of the S&P 500 from 2000 to 2009. And I think it's negative 1% or so annualized return, where if they had $1 million, it's worth 900 and something thousand at the end of the decade. And then side by side, I'll pull up different asset classes like the Russell 1000 or small cap or value or international, or even better, showing them emerging markets during that time period, which had a 9+% annualized rate of return. And so again, it's that recency bias of, let's not just look at the last 5 or 10 years. We need to zoom out. And this is why you pay us. This is why we invest your money, to bring you this perspective. And so I think that's great. Another thing, a big emotion, is just envy and loss. Let's talk about that a little bit, because I know that drives so many consumers and investors. What does that affect?
Yeah, that's really two different ends of the spectrum, right? Think about envy and loss, and these are probably one of the more studied emotions in this psychology investing world. But we've talked about envy to some degree, and some of it's about regret as well, right? If you think about, we should only regret bad outcomes, but think about how many times we regret maybe things could have been a little bit better if we just did things a little bit differently, right? It's that FOMO, right? The millennials talk about, that fear of missing out, that all the time with investors where the outcome is pretty good, but they still are thinking about how it could have been even better. And in our presentation, we have an example that really resonates with investors, and it has nothing to do with markets or economies. It's all around the Olympics. And they look at the happiness of medal winners on the podium, something I think everybody can relate to, especially we recently had the Olympics top of mind for some folks. And they do these studies every time the Olympics rolls around. And what they find is, on the podium, the bronze medal winner is 1.5 times as happy as a silver medalist. Of course, the gold medal winner is the happiest. We throw them out because that's not very exciting. But think about the bronze medal perspective for a moment. They're just happy to be there. I'm not sure what you get for fourth place in the Olympics, but it's not a medal. It's not being on the podium. It's not getting your country's flag raised in your honor. So enormous difference between third and fourth place in the Olympics versus, think about what that silver medalist is thinking about. They're thinking about what they could have done differently to make up those fraction of inches, fraction of seconds, fraction of points, that the difference between gold and silver. So they're riddled with that regret on the podium, and that eats into their happiness. And I think that's something we need to think about, because that is the story of the diversified portfolio, right? You always feel like that silver medalist on the podium where, hey, if we would have just owned more stocks over the last 10 years, we would have done even better. If we would have just owned more technology or whatever it might be. But to your point, it really is those times where the market, to that lost decade or other periods where the market won't achieve average or above average returns, that some of those diversifying pieces add their most. So for us, that's the envy side of the story. Loss on the other end of the spectrum. Yeah, this is probably the most studied part of behavioral finance, is this loss emotion. We probably all heard loss emotion can feel twice as bad as gains feel good, right? I think we can all relate to that. We've all probably been there at one point or another where losses feel twice as bad as gains feel good. And that emotion can drive folks to do all kinds of irrational things. And we talked about just poorly timing the market. Think about how that all connects back to that loss emotion, because what that loss emotion will drive folks to do is you want to do something about it. Think about anytime anything goes wrong, or things like the car breaking down, naturally you want to take action, or you have to take action to get it fixed. Certainly, I'm not going to fix the car. I need to take it into the shop to get it done. This is a natural thing that comes out of that loss emotion, is you want to take action. Investors will want to they just don't want to sit there and take their lumps, or rarely do they want to do that. So it's a natural tendency that comes from this loss emotion, is you want to do something. That's where our job as financial professionals is to take that action in a positive way, not a negative way. So that loss emotion can be really damaging, even for good investors who are experienced, right? They can get in a situation where that loss emotion gets revved up. They want to do something about it. They'll do something at the worst time. I think, as we've all seen over the years, that loss emotion can be really damaging. And I think we probably all think we know it, but it's amazing how often it still comes up consistently.
Yeah, exactly. And it's also important to know that the person that you're sitting down with. I remember reading a book that was written on like the top 20 greatest athletes of all time. And like the one common characteristic of them is they all hated to lose more than they liked to win. And so I think for some of our clients, they hate to lose more than they like to see the gains. And so it's just understanding that dichotomy of risk and return and how much volatility and what the client's goals and objectives are. And I also learned another thing while you were talking. I went to ChatGPT, and somebody who gets fourth place in the Olympics is awarded an Olympic diploma. So I haven't seen too many people bragging about their Olympic diploma, but that's awarded to fourth, fifth, sixth, seventh, and eighth positions in the Olympics. So now we know. Mark, let's close out here. And I think it's safe to say some of our advisors' clients who have a pulse on their finances may feel in similar ways to the things that we've discussed today. I think particularly in light of the environment we're in right now, we have an election, there's an incredible amount of uncertainty. I think when we go through election cycles, people become weary of their money, of the markets, of the economy. And I think there's some gasoline on the fire going into this election with what's going on. So, how can the advisors be a good resource to their clients? And any just insight or pieces of wisdom you can share on everybody as we close out here?
Yeah, I'm glad you brought up the election because this is a great example of emotions getting in the way of success. We've seen it come up a ton here, and still only right in August, so we still got a couple months here. But and I think this highlights another thing: the election is just an example of how the news and the press and all those things can be enormous distractors from investor behavior. My 30 years in the industry, it happens more today than it did 30 years ago. It's just the way news companies have changed their business models as well, right? That we could probably do a 30-minute filibuster on this topic alone, right? It's just how they've changed. But the bottom line is they're enemies to that investor discipline. So don't underestimate that as well. Again, we get tons of calls from this. And again, oftentimes it's too late, right? When that emotion's been revved up. But I think for us, think about that educational piece, think about that check and balance, try to be that emotional check and balance. And most importantly, just having that plan, right? The bucketing plan, having that bear market plan, all these things will help you better execute even with your most emotional clients when you need to, when it's the toughest. That's really what we're trying to get after here. And I think all those pieces are connected together. And we have a lot of resources. If you just pull up Psychology of Investing at BlackRock, it should pop up. Also, our Student of the Market that has a lot of those pieces as well. We do that on a monthly basis, but we do have a Psychology of Investing webpage out there that's got some great resources. It's great. Somebody pulled out the chart. See how resourceful your crew is here. My favorite chart. Don't leave home without it. But those kind of resources are available, and I think are a great way to really get this conversation going with folks.
Yeah, that's great. My big two takeaways from here, the S&P Envy chart is awesome. I already saved it into our team at Alison Wealth Management, our investment folder. I sent it out to our team in a Teams chat while we were speaking because that's just such a good proactive piece for education. And then I love your terminology on a bear market plan. I think that just shows people we're proactive, we're forward thinking. With markets, it's not a matter of if it goes down, it's when it goes down. And to be proactive about having a bear market plan in place is just awesome. Mark, we greatly appreciate you joining us today. And stay tuned for next week's coffee break. We have our Chief Marketing Officer, Matt Seitz, Carrie, our head of our marketing agency, Erica with our marketing agency. They're going to be discussing lead generation ideas for YouTube and Facebook, something I'm really excited about. We started doing a bunch of Facebook ads around the Bucket Plan book, and just in 3 weeks, we've generated almost 200 leads at a cost per lead of about $5. I'm really excited to see what they're going to talk about there, and so much opportunity to continue to get this message out and help more people. Mark, thanks so much for your time.
Thanks, everybody.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable, but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.